There's so much economic data coming at you today. So many economists and talking heads are telling you that the data is a sign of bad things to come. They're saying things like inflation is not coming down. Interest rates are going to have to go even higher. A serious recession is all but inevitable. But not everyone sees the data this way. And today, I speak with one of Wall Street's most respected economists, Dr. Ed Yardeni of Yardeni Research. He thinks we're probably in for what he calls a soft landing in the economy. He also thinks the stock market is going to end this year up, potentially significantly. That's not what I'd call consensus thinking. But before you discount it, Dr. Yardeni has seen a lot of cycles over his 40-plus year career on Wall Street. And if you're thinking that the market is in trouble right now, challenge yourself by giving Dr. Ed a listen. Dr. Ed, it's great to see you. Thanks for joining me today. It's funny, I was talking to John Malden recently, and I know you and John are good friends. And I said, John, you're starting to hang out with the bulls. And he said, well, I always listen to what Dr. Yardeni has to say because it keeps me grounded.
Thank you.
So what a week. The Fed Chairman Powell scared the markets by just sort of hinting that maybe 50 basis points could be on the cards for the next rate hike. The markets got spooked. People are now starting to talk about Fed fund rates with a 6 handle. Has any of this changed your generally bullish outlook for the markets this year?
Not really, but like everybody else, especially like the Fed, I'm data dependent, and there's going to be a whole slew of data over the next several days, and this data is all very important. It includes things like the CPI inflation rate, retail sales, and the Fed will react to these numbers. I mean, clearly. Before we got all of January's numbers in February, and they were surprisingly strong, we saw that the Fed was kind of a little bit toning down its hawkishness. But then when all that strong data came out in February for January, I think Fed officials started to talk about being more hawkish in terms of instead of just 25 basis points, they might do 50 basis points at this next meeting. And then we'll have to see what follows. But look, I think the economy is doing quite well. I was in the soft landing camp last year and early this year, and I was sort of debating the folks who were in the hard landing side. And now all of a sudden I'm debating folks who are in the no landing side. And there's, concerns that if there is no landing, we're going to get persistent inflation. And if that's the case, the Fed will have no choice but to raise interest rates to cause a hard landing. So, I hope I'm not getting too many landings here, but I think the concern is that the no landing scenario eventually leads to a hard landing anyways. But I'm not in that camp. I'm in the soft landing camp. And I think inflation is still coming down, and that should give the Fed some comfort. I want to make one more point here, and that is the Fed has made it clear that they want to get the inflation rate down to 2%, not this year, not next year, but in 2025. And I think they can do that without a recession.
That's interesting. So they've got plenty of time for the poison to work, so to speak.
Right. I agree.
One of the things that Chairman Powell got beaten up on in Congress this week was, this fear that raising rates too high would cause a recession and that would cause a lot of job loss.
Right.
We have so many vacancies right now. Like there's 10 million vacancies or so that need to be cleared out before we start to even see real job losses. Do you agree with that? I mean, does the Fed have a lot of runway to go here?
I think that's the widespread concern, the increasing concern now that more people are worrying about the economy being too strong and inflation being too persistent. That is clearly one of the main reasons they're worried is that the labor market's been remarkably strong. Look, I think we've got chronic labor shortages, and I think employers increasingly are going to resist increasing wages much more than they have already. They've increased them quite a bit. The problem for workers is those wage increases have been offset by price increases. So a lot of workers say, thanks but no thanks. It was nice to get a big pay increase, but it wasn't nice to have to go spend it and find out that it didn't buy you much more, or maybe even a little less than you had before this all happened. So I think the labor market is a an issue, and I think companies are increasingly going to resort to means of increasing productivity. I mean, you're not going to change the labor market by raising wages and prices, wages and prices. That kind of spiral is not going to work. Meanwhile, I think consumers are starting to resist some of these price increases. A lot relatively good substitutes. So I do think that we are going to see rent inflation come down in the second half of the year. I think a lot of these services inflation rates that the Fed's been concerned about, I think we'll see them moderating as well. And meanwhile, we have seen a pretty substantial drop in the inflation rate for things like consumer durable goods. Put it all together, I think we're going to get inflation on a what's called a consumption deflator. It's kind of like the CPI, but it's a little bit more realistic in terms of what people actually spend on. I think it'll get down to 3 to 4% by the end of the year, and right now we're a little bit above 5% on that number.
At what point do you get concerned, Ed, that maybe the Fed has gone or is going to go too far, and then things do in fact break?
To be brutally honest or painfully honest, I'll probably come to that conclusion at the same time as everybody else does. I think what's worked for me so far is the notion that the economy is resilient, that instead of an economy-wide recession, that we actually have been in a recession since the beginning of last year. It's just been what I call a rolling recession, affecting different industries at different time. Housing has been in a recession and is still in a recession. A lot of people went on a buying binge for goods at the retailers in 2020 and 21, and by 2022, when ironically a lot of the inventory finally came from overseas, got unjammed at the LA ports, the consumer said, no mas, we don't want any more. We got enough. And they started to pivot towards services. And so the goods industries have been feeling some pinch or an outright recession. And commercial real estate's in some trouble. I think that there's enough restriction coming from the Fed right now that if they do what they said they were going to do, get it up to a restrictive level, and I think 5.5% is restrictive enough. Certainly, the mortgage rates are restrictive enough, and I think they leave it there and then let that kind of work its way through the system to continue to help bring inflation down. But there is that risk that they decide to slam on the brakes, but that would be inconsistent with their opinion expressed in the summary of economic projections. That's something they put out every quarter. When they have the so-called FOMC meetings, they're meetings of policymaking. Actually, I think they have 8 meetings every year, and 4 of those on a quarterly basis, they put out this SCP, the Summary of Economic Projections. And it's very clear. They said they want to get the inflation rate, I should say, they want to get the inflation rate down to 2.5% by 2025. So if they're going to be consistent with that, I think it would augur for getting to a level that's restrictive, and I think we've got to be pretty close, and then just keeping it there. And we'll see how long it stays there. But the bond market certainly is of the opinion that Fed policy is restrictive enough, and if it gets any more restrictive, then we might have a recession.
So many economists and market analysts seem to have been caught off sides with the Fed taking rates even as far as they are now. But if you look back over the past year, they've done what they said they were going to do.
Yeah.
I don't understand why so many people missed it, frankly.
Well, I think it's because the Fed itself has been changing the idea of what is the terminal Fed funds rate. And remember, they started out last year with only a 25 basis point increase, and then suddenly it becomes 50 basis points, and suddenly it's 75 basis points. So I think a lot of it has to do with the fact that they are data dependent, and the data turned out to demonstrate that inflation wasn't transitory, that it was much more persistent. I happen to believe that it actually has been transitory, particularly in consumer durable goods, and a little bit more persistent in food and energy. But it's the services area where it's been persistent, and I think you got to give that some time, and you'll see that it'll be less persistent later this year. So I think everybody's, I don't know too many people who anticipated at the beginning of last year that we'd be getting up to a 5% Fed funds rate. I think most people, if you told them that that's what's going to happen, said, no way that's going to happen, because somewhere between 0 and 5%, the economy is going to get crushed. And that just doesn't happen. And that's because the financial system is in much better shape than it's ever been. And we're not getting a credit crunch.
Well, you mentioned credit. I saw today something came out from, I think, Wallet Hub talking about how the pace of consumer credit card debt has went up in February more than ever. So I wonder, do you look at consumer debt loads and think maybe that's what finally puts the brakes on service inflation because people can't consume anymore?
Yeah, I think it's the level of consumer credit that got to an all-time record high, and we all look at the revolving credit component of that, and that's what we know as credit card debt.
Right.
And it's at an all-time record high, but a lot of people do use it for convenience. They do pay it off, and if they don't pay it off, they pay some of it off. And it's conceivable. I mean, it's very likely that some people are doing it because they're stretched and they're financially having problems, and others may just feel, that they are weathering all these storms, they're doing well, and they can use their credit card. So it's a hard number to interpret. I've never really personally used it as an indicator for forecasting the consumer. To me, what drives the consumer to a large extent is the obvious, and that's jobs. And jobs are continuing to expand rather rapidly. We'll certainly get more jobs data in the next couple of weeks. We'll get the initial unemployment claims, but they all suggest that the labor market's still providing jobs, and even wages seem to be finally, after a year of not doing so, wages are finally rising a little bit faster than prices.
So we've covered the economy. The economy is holding up remarkably well. The economy is not the same as the stock market, as any investor knows or quickly learns. So what are your thoughts on the stock market? I've been reading your research lately. It's excellent, and you had two sectors in particular that you said you favored. One of them really surprised me: industrials and IT, which really, I had to reread that section.
Yeah.
What are your thoughts on the market in general? And then maybe we can move into those two sectors specifically.
Sure, absolutely. Generally speaking, I have not anticipated an economy-wide recession. In the past, bear markets were often caused by recessions, and those recessions were often caused by credit crunches. So I didn't anticipate that we would get a credit crunch this time, and so far so good. And so far so good. We have yet to get an economy-wide recession. There's been a lot of talk about it for a while, and it just isn't happening. And again, I think it's because we got this rolling recession going on in the economy, so it's kind of self-correcting in a lot of sectors without taking the entire economy down. Now, I always say that forecasting the stock market is very easy. All you have to do is forecast earnings, and the PE, the valuation of those earnings. Getting the two numbers right, that's the challenge. Anybody can forecast two numbers. That's no big deal. But it's been a wild ride here. We've seen the valuation multiple basically drive stocks down sharply from January 3rd of last year through October 12th of last year. And the bulk of that decline, about 25% drop in the market, was due to actually a 30% drop in the valuation multiple. And the earnings numbers that I look at, which is forward earnings, analyst consensus expectations, which is what I think the market discounts. It looks ahead and it gets a clue from what analysts are thinking earnings are going to do. Well, now where are we? Well, we've seen the forward PE drop sharply from around 20 to 15 during last year's bear market. And a lot of people are saying that's not low enough. Bear markets usually end when you're 8 to 10. And instead, the PE went back up to 17, 18. And for a while there, the big technology names or names that are associated with technology, not all of them are in the technology sector, but the so-called mega cap 8, the magnificent 8, if you will, they weren't so magnificent for a while there, and they all seem to have their own problems. But all of a sudden, investors want to own them, and even though their multiples are around 22, and that's what's really holding up the multiple of the overall market. But I think I think we did make a low on October 12th for the bear market. I think we're in a bull market, but it's not a V-shaped recovery in stocks. One is they're not that cheap, and two, there's still a lot of uncertainty about Fed policy, and there's still a lot of debate about whether we're going to get a recession one way or the other. But I do think that earnings, which have been coming down from the analysts, I think as they get more information from the company suggesting that they're still doing okay despite all the recession talk, I think earnings will make a comeback. And I could see the market by year end somewhere to give me a wide berth here. I'll take 4,500 to 4,800. I think we could do that. That would require a pretty optimistic outlook for earnings, which I have. For this year, I have $225 a share. I think I'm at the top end of the range. I've heard numbers like 185 as earnings per share for the S&P 500. And then for 2024, I'm using $250 per share. Wow. And then I'll slap a 17, 18 multiple on that, and I can get to over 4,500 with those kind of numbers.
Specific to two of your sectors that you said you liked, when I think of IT, I sort of lump it into tech. And when I think of a sector that does poorly in a rising interest rate environment, it's tech. Mm-hmm. What is it about IT specifically? How do you define it, and why do you like it here?
Well, I take the official definition. When I talk about sectors, I talk about the S&P 500 sectors. The S&P 500 is basically a managed portfolio, if you will. You can certainly buy ETFs that track the S&P 500, and the S&P that provides that data also provides data on the 11 sectors of the S&P 500, which try to reflect what the economy is doing to some extent. And technology is one of the sectors. And, anybody who owned some of the ARK stocks, the Cathie Wood ARK stocks, feels like, IT can really pick your pocket pretty quickly here after making you feel pretty rich. I'm not talking about kind of the growth stocks without earnings. I'm talking the growth stocks with earnings. And even the mega cap 8 stocks, again, not all of them are in technology. For example, Netflix is in communication services. Google is in communication services. Amazon is retail. These 8 stocks account for about 20% of the market capitalization of the S&P 500. They're huge, and they were supposed to get their comeuppance, and they did sort of, but we're seeing money pour back in there. But the fundamental reason that I like technology is I tend to view the market as appropriate for long-term investors, not for day traders. I mean, clearly there are people who plenty who do it, but that's I don't provide good insights for day traders. I tend to focus on the long term, and I think one of the things that is very important is stocks pay dividends. Now, as we know, not all technology stocks do, but increasingly they are. But the big story, I think, is that as bad as things feel right now, things might actually get a lot better. Right now, it kind of feels like the 1970s on, the great inflation of the 1970s on steroid and speed. I mean, it kind of makes your head spin how quickly things have unfolded. We had a terrible recession in 2020 that lasted 2 months. We had a 12-month recovery, just V-shaped. People were questioning whether that was going to be V-shaped. And now we're already talking about stagflation and, hard landings and soft landings and the whole thing. But I think all this period of turbulence is going to give way to better times led by productivity. Again, call me an optimist. Maybe I'm delusional here, but I think that companies that have recognized that the labor shortages are chronic, they're not just going to willy-nilly just keep increasing wages and prices, and we're just going to have this wage price spiral plaguing us for the rest of the decade. I think within the next several quarters, we'll see more evidence that productivity really is making a comeback, and productivity allows wages to go up faster than prices. that validates it. Without productivity, wages can go up, but they're not going to go up any faster than prices. So nobody wins in that situation. And I think the technologies that are available out there are very useful for increasing productivity. We all saw just a week or so ago the excitement over artificial intelligence.
Sure.
And I think that's just the start. You can see that the market, investors really want to be optimistic about the future. And I think, something like that got them excited. It could be, hype for now. But a lot of these technologies are going to work for increasing productivity.
Maybe the fears about AI are a little bit overblown in terms of losing jobs. People, I saw one great quote. I can't remember where I heard it, but somebody said you might not lose your job to AI, but you're going to lose it to someone who knows how to use AI, which I thought was pretty brilliant. But again, there's a lot of slack in the economy and in the way the labor market that we could lose some jobs.
We could lose some jobs, but the history of technology is that there's always kind of a popular movement against the technology because it's going to destroy the jobs. And then it turns out that they were right. It destroys certain jobs, but it creates whole new jobs.
Yeah.
And that's the important thing to recognize. And instead of having to be a master or an expert in AI, there are likely to be AI applications that allow a lot of people to do a lot more things without necessarily knowing anything about AI.
Dr. Ed, you mentioned your research and how you focus on investing instead of day trading.
Yeah.
I'm going to have a link where viewers and listeners can learn more about your research. But you just launched a new service called Yardeni Quick Takes. Can you tell us a little bit about that? What is it?
Yeah, well, we traditionally have provided our research to institutional investors, and we continue to do that. But along the way, we've constantly gotten requests for sort of a stripped down version, something that's more tailored to individual investors without getting into the weeds. And so that's really why we created this thing. And what it really does is sort of combines economics with investment strategy. What we try to show in the Quick Takes is here's the data that came out, and here's why it moved the market. Or here's the data that's going to come out, here's what we think it's going to do, and here's what we think the market might do. So it's I think what makes it fairly unique is that top-down approach that combines two top-down disciplines. One is investment strategy, and the other one is macroeconomic analysis. Well,
you're one of the rare institutional research providers that can actually speak plain English, and I appreciate that. So
I like the English language.
And I hope we can get you at our strategic investment conference this year as well.
Sure. That'll be wonderful.
Before you leave, please do me a favor. If you haven't already, subscribe to our YouTube channel. It really helps us out a lot. I'm Ed D'Agostino from Malden Economics. Thanks for watching.